Grazie a tutti coloro che si sono collegati. Thank you everybody who is following our webinar of today. La lingua del seminario di oggi sarà l'inglese, quindi abbandono immediatamente l'unica lingua che conosco per passare a una dove cerco di interloquire con i nostri ospiti. The official language of today's webinar is English, so I'm immediately switching to a language I don't know, which is very good because I will be short in my introduction. Today's webinar is about where is oil heading to. In the past 10 years, we have seen more price, supply, and demand variation than possibly in any other period in the entire history of the oil industry. We have seen about 12 years ago the highest prices on record in July 2007, and we have seen a few weeks ago the lowest prices on record when the WTI hit minus $30 per barrel. In the meantime, while all of this is happening, of course, the world economy is in a very bad shape because of the coronavirus crisis, and countries all over the world are struggling to promote investments in alternative energies in order to reduce CO2 emissions and to decarbonize the economy. So we have a lot of stuff to debate, a lot of things to understand, and we at IBL thought it was a very good occasion to ask two friends of ours to join us and share their expertise with IBL's friends and followers. The persons we have asked to join us are Dr. Carole Nakhle. Carole is founder and chief executive officer of Crystol Energy, a consultancy based in the UK. She's also the promoter of a non-profit organization to promote access for women in energy, which is active, I think, since 2007 or so. And finally, she's a lecturer at the University of Surrey. A few years ago, she wrote a book, Out of the Energy Labyrinth, with Lord David Howell, former Secretary of State for Energy in the UK. It would be interesting, by the way, to hear from Carole how much she would rewrite of that book. As far as I can remember, I think you got many things right. So cheers for the two of you. And Michael Lynch, Mike has a very long experience in the oil industry, which is a very kind way to say that he's the oldest one among us. Mike is a very well-known American oil economist. He was a scholar of Morris Edelman, and he's now the chairman of the Strategic Energy and Economic Consulting, which is again a consulting firm based in Boston, I think, in the United States.
Boston.
Near Boston, okay. So I think I've already told too much, so I leave it immediately the floor to Mike, who, by the way, wrote a book a few years ago, I think in 2016, yes, about his favorite issue, which is peak oil. As many people can remember, we have been spending the past few decades saying that oil will be running out in a couple of years or so. So my first question to Mike, but of course you're free to pick up from there to go wherever you think is interesting. Is oil running out?
No.
Okay.
That's the problem. We have a huge resource. The question is, can we use it? This is, Morris Edelman used to joke that he'd been through 3 or 4 periods of people predicting the peak in oil supply. And he told me, don't worry, there'll be another. And we've seen another. And we've already seen people say that underinvestment from the current crisis is going to cause another price spike in the near future. I'm not convinced of that, but we'll talk about that and some other things. Grazie, Carlo. As he says, I'm an American, which means I only speak English and not very well, or as the English would say, I only speak American. This has been a historic price collapse. We've never had a demand collapse so strong and so fast, even in the Great Depression. To get back to normal, we're going to need the pandemic essentially to be more or less over and demand to be mostly restored. And then there's going to be an inventory overhang of hundreds of millions of barrels that have to be worked off. Once that happens, we'll get close to normal equilibrium in the market. Unfortunately, we don't know what the normal price is going to be after the pandemic, and I'll talk about that. Now, I often tell people it's not just a question of economics. You need to study history. Unfortunately, many people do not learn from history, including a lot of, well, most politicians. The things I've written about in the past is the tendency for people to look at short-term events like oil crises, oil price spikes or collapses, and think, this is the new normal. This is really a long-term trend. But also to realize a lot of experts have been wrong very often. I mean, I've been wrong many times. But there are a lot of people who speak and write who are not really expert. And I'll give you a couple examples soon. In one case, during the second Arab oil embargo, which was the first oil crisis in 1973, Robert Solow said, I can prove mathematically that oil prices have to rise exponentially, ignoring the fact that oil prices had never risen exponentially before. And frankly, he was not a resource economist. He's a very good economist, but he's not a resource economist. His colleague, Maury Edelman, said, no, this is a question of the OPEC countries cutting production and sending prices up in the short term. Unfortunately, people listened to Robert Solow, and for about 20 years after that, almost every price forecast said the price will rise exponentially, usually about 3% a year. This is the Department of Energy forecast over time. The IEA forecast would be very similar. Almost nobody saw the price collapse in 1985. And when that happened, almost everybody predicted it would be short-lived. The same thing happened in the other direction. This famous 1998 Economist cover, Drowning in Oil, when the price collapsed down to $12 a barrel. And the Economist story said, well, most people think it's going to stay here for an extended period, and it might go down to $5 a barrel. Instead of recognizing this was just a price war, and price wars never last for extended periods, months, not years. A good history lesson, or a good lesson in the failure to know history. This was a typical comment from peak oil people. Joe Rahm, who's an MIT PhD, but in physics, said, well, everybody knows you need to replace an amount of oil equivalent to Saudi Arabia's oil production every 2 years. He did not know that in 1977, President Carter said, we need a production of a new Texas every year, an Alaskan North Slope every 9 months, or a new Saudi Arabia every 3 years. Obviously, this cannot continue. Neither of them seem to be aware that although oil wells decline, the industry has always been replacing them and still managed to come out ahead. This is an extremely simplistic slide. The oil price spikes and collapses have been fairly complex, but I think it's useful just to point out that in 2014, the prices were at historically high levels, and yet almost everybody said the floor price is $100 a barrel. There's a video on the OPEC website from 2012 where an oil company CEO suggested I might be an idiot for believing the price would drop to $50 to $60 because he said the marginal barrel costs $100. He's a CEO and didn't have time to listen to a 15-minute explanation of the microeconomics and why he misunderstood them. But it's important to think, why did so many people think the price couldn't go down from the all-time high? Now, 1998 was the opposite. We were at a low price and then it collapsed. And it should have been obvious that it would go back up. But as I say, although a lot of people thought that, the economists and some people in the industry didn't. the 1986 and 2014 are kind of intermediate cases where the price had come down from severe peaks, but was still kind of high. So you could argue that the price potentially could come down as they did, but that it's not necessarily the case that they would, or that they would stay low. But again, after the price came down in 1986, it stayed low for 15 years. During the entire time, people in the industry tended to say, this is not normal, we should go up again. That's a misunderstanding. Prices can go up, but they don't have to. So what's going on right now? There are people talking about demand destruction and how peak oil demand has been accelerated. And peak oil demand is a real thing. Peak oil supply was not. But again, I think this is primarily transient. It looks like we're getting past the worst of it, that we're going to see some economic recovery. We might have a rebound in the virus. I'm not an expert on that, and I won't pretend any expertise. But it looks like demand is going to start to recover over the next few months, and we'll get to the point where inventories at least will stop building and may start coming down, depending on what OPEC and other countries do. And then that gets into the question of the economy. There are people saying, we're going to see a permanent change in the economy, but other people worry that, we may have lingering weakness. There's a lot of debt overhang, and what may happen is you have so many unemployed people around the world who are in financial distress, and companies, that spending will be depressed for a lengthy period and will crawl out of this very slowly. I certainly hope not. In terms of permanent changes, though, 9/11, the attacks, or as you would say in Europe, 11/9, the September 11th terrorist attacks, a lot of people said, now we have the internet and air travel is going to be a lot worse, so air travel is going to fall off. This is million passenger miles in the US, and you can see it did fall off and then recovered. Then the recession caused it to fall off, and now it's back. There has not been a permanent change from people doing Zoom or its predecessors, which were frankly not quite as useful. And I'm not convinced that we're going to see that happen. Personally, I'd much rather be in Milan right now or in Abu Dhabi with Carole. After 2008, in the US especially, a lot of people said the auto industry is doomed. Millennials are not getting driver's license. They've all decided they don't need cars. Everybody's using ride sharing. Now, this is auto sales in $1 million, but you can see the trend actually is higher since the last recession, which is partly more expensive vehicles, but you're certainly not seeing any big shift away from cars. And some people are worried that you'll have some people working from home and saving gasoline, but other people who used to take mass transit deciding they don't want to risk it and taking cars. The jury is still out, as they say. It's not clear. I remain unconvinced that people are going to do substantially less driving once the pandemic ends. One other thing that comes to mind is there's a lot of irrational exuberance, in human nature. And when people talk about the energy revolution, I pull out any number of slides. I have a number of presentations on this and talk about revolutions that did not occur. And this is one of my favorite slides. CNN had a story in 2007. They said, Detroit is too stupid to understand how to make electric cars. Silicon Valley knows how to do it. And there are, this is actually 6 companies. They say they're going to revolutionize the industry. They said, we're ignoring Tesla. They're just doing luxury vehicles. All of these companies are gone. Tesla's still around, obviously. This is the Aptera, which was proposed. And frankly, in 2007, electric cars had very little power. The batteries were far inferior to what they are now. And the cars were lightweight and could hardly carry anything. And yet a lot of people all over the press, a lot of pundits and advocates said, aha, this is the end of the gasoline engine. We're a lot closer to the end of the gasoline engine now than in 2007, but I'm not sure we're close. I remain unconvinced that batteries are really good enough at this point to be mass market vehicles, that is to take over more than a few percent market share from the gasoline engine. Now, going back to oil, I'll talk briefly about what's going on. You know, people talk now about oil being shut in. And if you go back a month ago, everybody was worried that inventories would get so full that producers would be told, there's no place to put your oil. You have to shut your wells in. I call this after a famous Italian movie, The Good, the Bad, and the Ugly, starring famous Italian Clint Eastwood, I guess. The good is, okay, people say, look, let's do maintenance now, since the market's so distressed. That mostly works for refineries and offshore fields. I think you're seeing a lot of shut-ins in the U.S. shale fields where people are saying, you know, when the price was 15, 20, they said, hey, the price is going to be 30 or 40 at least in a few months. Let's wait. Let's sell it then and make a lot more money. So I think that's part of the shut-ins where you're seeing maybe 4 million barrels a day shut in the U.S. and Canada. The bad, I say, is operating costs not being covered. People saying we're not even making enough to pay to keep the pumps going and the maintenance being done. I think that may account for about half of the shut-ins we've seen. There's a wide range of estimates for operating costs in the shale fields. The ugly is, you know, we can't sell the oil. That doesn't seem to have happened very much. I've seen very few cases of that. This shows you the U.S. shale was the revolution. Now what we're seeing is falling off a cliff. These numbers are probably understated. The decline is probably understated, but it's definitely down, and it's down sharply, reflecting the fact that shale production is pretty expensive. It is not by far the cheapest. It's sort of medium cost and above on a good day. This is where I've calculated. I said, okay, drilling in the shales is down recently about 2/3. What I did was I have a spreadsheet model set up to show what happens when you reduce drilling, taking into account the decline rate in the older wells and whatever drilling does occur, adding new capacity. Plus, I factored in the recent drop, and I assumed that would come back partly, but slowly. But you can see that under if you assume that the prices stay, we'll say below 40. What you wind up with is by the end of 2022, you've lost about 4 million barrels a day of supply. That's the biggest decline since the Iranian Revolution, I guess, or the Iran-Iraq War. You've never seen a commercial decline on that level. That would be very beneficial to OPEC Plus. But again, it requires a price below 40, I'm going to say. And after the 2014 price drop, you did see a dip. Go back to that, but then a recovery and sharp growth. And what that was, the oil companies in the shale fields, when the price was $100, their goal was to get the production online quickly. When the price dropped, they said, look, the goal has got to be cut costs. So they greatly increased efficiency. This is barrels per day per rig, a very imperfect measure, but only one we've got. But they did that, and that's, as they say, the low-hanging fruit. There's no more. I don't think they can do that again. So if the price stays at $30, $35, you might see production flatten out at some point, but I kind of doubt it, and I don't think below $50 you're going to see significant production growth. So longer term, that's the big question. The shale was what pushed the price down before the pandemic. And we don't know when drilling is going to come back. That's something that we have to watch for, and I'm sure the Saudis and Vladimir Putin are watching for. What's the oil global economy going to do? Will it grow slowly or not? Will we be back to normal, most close to normal in 3 to 6 months or 2 years? What's normal oil demand going to be like? Like I say, I'm not convinced that we're going to see a substantial change in people's behavior. I think people are dying to go on vacation, dying to fly around the world, but we're going to find out in the next month, and that's something to watch for. One other thing I'll mention is, frankly, we could wind up with a President Biden by next January, and he is not going to be a friend to the U.S. oil industry, and that could be that could have a bullish effect on prices in the longer run. So with that, I'll throw it back to you.
Thank you very much. Thank you very much, Mike. So you have provided some food for thought, which I leave it immediately to to Carole for taking up from here and to lead us where she believes is good. So Carole, the floor is yours.
Wow, you gave me a very difficult task. I don't think I can lead you anywhere. I think we are all sailing in the fog today. So God knows where we're going to end up, at least in the coming months or to the end of the year. But let me pick on a very important aspect that Mike referred to, the importance of history. And Carlo, you mentioned in your introduction that I teach at the University of Surrey, and one of the lectures I cover is the history of the oil industry. And it's interesting how much of history, even if it doesn't repeat itself, how much of it rhymes, to quote Mark Twain. And even when we saw oil prices going into the negative territory last month, actually 2 months ago, since we're already beginning of June, everybody thought, well, call it unprecedented development. But if you go back to the 1930s, for instance, you could see that prices then crashed down to zero, but because there were no stringent environmental regulations and there were no future markets, then prices did not go into the negative territory. So the fact that we have volatility in oil markets, this is quite common, and it has been a feature of the oil industry right from its onset. And I know governments today, including the G20 declaration, say that they want to collaborate to establish market stability. But actually, if you look at the history, you can see that we had more market instability when governments tried to correct the market. So that's just one observation since we start talking about history. But looking ahead, first of all, just to clarify, people talk about recovery today. And if you read the newspapers every day, you can see how the oil market is recovering, prices are recovering, demand is looking better. But again, this gives us a false impression that we are out of the woods. But actually, we are simply comparing the situation today with the very bad situation in April. But this doesn't mean that we have really recovered. Actually, we're starting from a very low base, so we have to put the numbers and the expectations into perspective. And the other thing that you notice today, first of all, we don't have reliable data. The numbers are incomplete and they are not reliable. So we have to wait a little bit longer for more reliable data to come in to be able to make a better learned judgment. But if you compare just a couple of statements, you can see the dichotomy and actually confusion dominating the market, not just oil market, but actually where the economy is heading globally. So for example, we see politicians trying to please the electorate, so they are relaxing the lockdown, but the scientists say that this kind of decision is purely political, and we are still in the middle of the infection. That was something that the World Health Organization warned about. President Trump tweeted a short while ago that energy is back. At the same time, some experts say that shale production, for instance, actually peaked in February and it's not going to recover anytime soon. Some report that demand of oil in China has recovered nearly to the same level as we had last year, but actually the Chinese are buying oil like crazy to store it and not quite really for final consumption, while the IEA says that the consumption in China is going to remain lower than last year for each month of this year. And then you have the Russian energy minister says that the oil market is balancing in the next 2 months. But at the same time, we hear other voices such as the IEA saying, no, hold on a minute, we have to do more to rebalance the market. So really, we have a lot of confusion and we don't know where we're heading. That's why I love this kind of image to say that we're all sailing in the fog, at least for the coming few months, if not until early next year. This takes me to the theme I want to cover in my discussion today, that is investment. And in my opinion, I believe that investment in particular is in a gray zone. Now, I know already, I like to call it the old song when it comes to investment, and Mike referred to that in his opening remarks, that whenever we see prices coming down, yes, it's natural and normal to see investment being slashed, capex and opex, investment particularly in exploration, in pre-development phases. But this doesn't necessarily mean that the world is going to face tight supplies in the coming years. So if I go back to what happened in 2014, 2015, when oil prices crashed, we saw an amazing synchronization, I would say unusual synchronization between OPEC and the IEA, where they both were warning that the significant reduction in investment was going to lead to tighter supplies in the next 5 years. And that, of course, did not materialize. Now, again, actually, we're sowing more into oil than out of oil with all the plentiful supplies. And then today, the same polls are being made. I'm looking here at one company warning that we will have a deficit of nearly 5 million barrels a day by 2025, and that would push prices to spike. And again, in my opinion, this is a bit simplistic because we are simply linking investment to price as if price is the only driver of investment. But in reality, the investment decision is much more complex than just looking at prices. And here I want to refer to two important aspects that tend to be overlooked in this kind of discussion. First of all, the cost deflation. So typically we see cost following prices with a time lag of at least maybe 6 months. And the same thing when prices are up, we have cost inflation. So for example, in 2013, it was the CEO of Chevron who said that $110 a barrel for us was equivalent to $25 a barrel. What he was referring to then was the cost inflation. And when prices go down, the same thing happens. We have a cost deflation. So that's something to keep in mind. And the other thing is, which is an area I focus on in particular in my area of work, that is government policy. So what we usually have, we have this kind of, I don't like quite the picture of a swinging pendulum, and I'm going to tell you why. But typically what happens, you know, when you have investment, we have the kind of relationship between the host government and the investors, international companies. And the way the contracts at the end signed depend on who has the stronger bargaining power. And typically what we see is that when prices are high, governments tend to have the upper hand, and they tend to get away by imposing tighter fiscal terms, stronger regulations, more stringent licensing terms. But actually when prices go down, as companies have, you know, a worsening balance sheet, they have the luxury of being offered bigger opportunities, more opportunities than what they can afford. And as a result, we tend to see around the world competition for capital among host governments. And this is what pushes governments to revisit their licensing terms, their fiscal terms, the regulations, to make the investment proposition in their country more attractive and make their regime more internationally competitive. And here I'm going to use one example of a country which rarely revisits its terms, its fiscal terms, and that is Norway. Norway takes pride in its fiscal stability, and yet look what they said when the government recently announced a package of measures to support the oil and gas industry. They said, and I quote, "If we lose the growth potential of this industry, we'll also lose much of the momentum in Norway's transformation." So oil and gas investment are still seen as important to many economies around the world. I'm not talking only just about the developing economies, such as here in the Middle East where I'm sitting at the moment, but elsewhere they play an important role. In the future, as governments become, actually, everybody's going to be poorer in the future, but particularly governments with all these fiscal stimulus and that they are putting in various economies, they will be, I think they will value more oil and gas revenues, at least for the time being. So in this respect, I think, first of all, it is, I mean, the effect of the crisis, even if it's over, I know that it was the chief economist of the World Bank who said, and I quote, that if it's not over with the disease, it's not over on the balance sheet. And I say, even if it is over with a disease, it will not be over on the balance sheet for a while. And that's something to keep in mind in terms of impact on investment. But again, I'm not, and I tend to be more of an optimistic economist. And I hear, if I look, for example, at a very interesting episode in the 1990s in the US Gulf of Mexico, which was then announced or declared like a dead sea for exploration in the 1990s. As you all know, prices were, we had a long period of low prices. And yet when the US government changed its fiscal terms, we saw record applications for deep water exploration. So again, I go back to this concept of investment declining, meaning tighter supplies in the future because of low oil prices today. This may be true, but I think it's much more complicated than talking about this kind of simplistic cause and effect between these important variables, and particularly if we factor in government policy, which varies tremendously between one country to the other. This takes me to the other aspect, Carlo, that you asked me to refer to, which is investment in alternative energy. Well, what can I say here? I mean, we're going to hear, and I'm sure some people will have completely different views from what I'm going to share with you. And I will not give you one particular direction. I'm going to give you just, you know, different variables to take into consideration. But Carlo, you mentioned in your introduction about my book with Lord Howell, Out of the Energy Labyrinth. I think we published it in 2007, if I'm not mistaken. And there we said that many ambitious climate change targets, you know, that the carbon dioxide reductions were going to be missed. And on that particular aspect, I think we were right, but of course we were wrong on many other things because we did not see, for instance, technologies such as development in the shale technology like many other people. But where we're heading today with respect to investment in energy, first of all, investment across all sorts of energy are going down. Yes, in oil and gas, they are going down by a third according to the IEA, but they have also been affected in the alternative sector, alternative energy, greener energy. But there are three dimensions that one has to consider when making like an analysis on where investment in green energy is going ahead and whether this current crisis will accelerate or decelerate the transition. First of all, from an economic perspective, as I mentioned earlier, we are all going to be poorer, but we have lower fossil fuel prices, so the competition with renewable energy and nuclear energy, of course, is going to be tougher. We also have low carbon prices that also makes investment in alternative energy less appealing than if we had higher carbon prices, and we also have low energy demand. So that's one thing to keep in mind. But and I think the economic case is perhaps clearer than the other two dimensions. First of all, there is a government policy dimension. So governments are going to be poorer. And as a result, typically what we see, and if you look at previous crises, any industry or any sector which relies on government support and on subsidies tend to suffer when government budgets are in the red. So in renewable energy, I know people talk about the improvements in cost efficiency, and definitely a lot of that happened impressively, but still they rely on government support. And this leaves us with a big question mark as to whether this kind of support is going to be maintained. I know in the UK, for example, now, quite surprisingly, the UK government is pushing for carbon capture and storage, but this is not new. They have been talking about carbon capture and storage for nearly 2 decades, perhaps if not more than that. And every time we have a crisis, these kind of projects tend to be delayed or postponed for an indefinite time. But at the same time, you have a lot of government programs, and some of these can be used to invest in greener energy. Again, we want to see that. Even there is this question of whether the oil industry deserves a bailout. It was a very popular debate in the US, and I think it was primarily the Democrats who said, yes, we can help the oil industry, but we need in return some kind of environmental concessions, such as, for example, commitment to reduction in methane emissions. And then the third aspect, which is societal pressure, our preferences, people's preferences. So yes, Mike said, most likely Zoom is not going to replace traveling, and I think people are going to end up driving more, not driving less, because they will be relying less on public transport. And there's also the issue of single-use plastic. Before we said, okay, let's recycle and recycle. Now nobody wants to use a plastic bag that was used by somebody else, or so that is something to keep in mind in terms of where we're heading. But at the same time, some people might discover the beauty of working from home and being with the family, and that also reduce the travel. So in this sense, when it comes to government policy and the society's preferences, I will not be able to make a more precise kind of analysis as I would do on the economic side, which is, I think, much easier. So all in all, as I said, I mean, we are still in a gray zone, too early to call a recovery. It can go either way with oil markets. Let's see what's going to happen next week with OPEC Plus announcement, but more importantly, what will happen in the coming months, what will happen to shale. In my opinion, I think shale is going to come back as soon as prices recover above the current price, and it's going to cause the same headache to OPEC Plus as it did before. And on the demand side, I don't think we are at peak demand yet, but I don't think we're going to see prices spiking to a level where it would make the energy transition a smooth ride as compared to what we saw when prices were in the higher levels in the previous years.
Thank you very much, Carole. While you were talking, we got a few questions, and I've got a surprise in the end of today's meeting. Well, first of all, Stefano tells us that he studied geology in mid-1970s, and back then there were a lot of people at universities saying that oil would be running out soon. So the forecast was not very accurate. But then I've got two interesting questions. The first one from Matteo, I think could be better answered by Mike. And the second one, who is from Carlo Amenta, I will read it to Carole. So Matteo asks, are we likely to see a wave of consolidation, mergers and acquisitions over the next few months, especially in the Permian? Are US banks going to be affected by a large wave of defaults if low prices environment persists? So Mike, this is for you, I think.
Yes and yes. There are a lot of mostly small producers who have big debt loads, a few big ones. Chesapeake Energy is most obvious. And they're just not going to be able to service these debt loads. So you're going to see bankruptcies, but usually wind up with acquisitions by the bigger companies that have deeper pockets. Deeper pockets always work well. I do think the banking industry will suffer some, especially you'll find that the regional banks have often in the past, unfortunately, thrown money at the shale producers without thinking about the real economics. So it was a quote, I won't tell you from who, but a very famous investment firm involved in an acquisition when the price was, the oil price was over $100. And they said, look, everybody's doing shale. We had to get into it. I know one of the investors put $1 billion in and they sold their share off for $1. So yeah, there are banks that make mistakes, that don't do due diligence. I don't think it's going to be big enough to affect the national banking industry, but definitely in the Southwest.
Thank you very much. Thank you very much, Mike. And I'm going to read Carlo Amenta's question to Carole. Carlo says, we all hope the new normal will have no differences with the old one. But if we end up with the worst scenario in which subsequent waves of the virus impose further reduction in demand after a sustained recovery, do you think there will be a long-lasting impact on the structure of the oil industry?
I mean, definitely they're going to see, if you look only at the industry itself, as if you're looking about companies, Mike referred to the wave of bankruptcies that we're seeing, for example, in the US, the shale companies, many of them are being squeezed, but this is not the first time that they go through this. And anyway, the industry structure, particularly in the shale industry, was changing before the current crisis hit. And I think the crisis has simply accelerated the process. And if it's going to get worse, we're going to see that more. Where I would see the change is actually first of all in terms of what kind of investment we're going to see, much more than the industry structure. So that will change where our oil is going to come from. But more importantly, in my opinion, and we start to see that already, is not in terms of collaboration between companies or competition between companies. It's more a collaboration between governments. So we had a taste of that back in April. And actually towards the end of March, where we saw that OPEC Plus nearly fell apart earlier in the month when Russia refused to join OPEC for further cuts as recommended by the organization at the beginning of March. And it was the first time since the formation of OPEC Plus since December 2016, Russia did not want to take part in these kind of cuts. But then not only what we saw after that, so when everybody started to see the severity of the crisis caused by the pandemic, that's when they realized that, hold on a minute, not only we needed OPEC Plus, we needed a much bigger group of producers to join. And that was a big surprise because we saw countries led by the US, which was very critical of OPEC and its manipulation of prices, joining and giving, not formally, not committing formally to cutting production, but they supported OPEC Plus. And the same thing we saw other countries such as Canada coming as well on stream, and Brazil. And I think if we see a worsening of the situation, this might strengthen further the collaboration between these governments. So this is where I would see the bigger impact as we talk about the industry structure, not just in terms of companies, like the big companies swallowing the smaller players and smaller players being squeezed out of business, and investment going to places where companies might be willing to have more rapid payback. But I would say it's more on collaboration between unusual suspects. I mean, as you can see, the collaboration is getting bigger and bigger in a short period of time.
Yes, thanks. I've got the last question, and then after which it's primarily aimed to Mike, I think, but it will be also interesting to hear Carole's opinion on this. And then I would give the floor to our surprise, who is Massimo Nicolazzi, who is one of Italy's greatest oil experts, who is in the public now, and who may want to make a short comment to close the webinar after your final responses. But the question we have from Vumi Ledare is, I keep hearing peak demand, just like the peak supply was in my days in graduate school. Mike and Carole, I would say, what is peak demand, and how would you compare it to peak supply that you and others debunked in those days?
Well, first, hi, Wumi. Hope you're well. I did a working paper actually for the International Association of Economics on peak oil demand. And my point was that, you know, peak oil supply, it was based, the arguments were based on bad math. They were geologists doing statistics, and they didn't know anything about statistics. The resource base is huge, so that was never a concern. Now, peak oil demand, or peak demand for anything, is a very real thing. Most of us probably don't heat our houses with coal or wood. On the other hand, the Stone Age ended about 5,000 years ago, and there's still a big stone industry. So it's out there. And my concern has always been, yeah, you know, you may see demand plateau at some point. Other things start to gain market share. But the problem, I think, is that you tend to have too many people engaged in irrational exuberance. That is, they want to wave off the economics. And I've been saying this for 20 some years. Ignore the economics, say consumers are really wrong. They don't understand. If only they understood, like we, the advocates for renewable energy and electric vehicles, do, then they would buy this stuff. And it's just because, you know, as one movie said, the car manufacturers don't use pretty models in their ads. That's not true. The electric cars are still not competitive in either quality or cost with the gasoline engine. They may be someday, but I think we're still a ways off. So I'm still a bit skeptical.
Carole?
Yeah, I mean, peak oil demand is going to happen at some point, where our demand is going to reach a peak and then starts to decline afterwards. And it simply means, in the economist language, that the market, it will be shrinking. And that, of course, will have many implications. But and I'll discuss them just briefly. But first of all, when will that happen? Already before the crisis, there was a disagreement in terms of when would that happen, because I think we do understand the oil supply much better than the demand, and therefore you see big variation between estimates and in terms of when will a demand peak. And now with the crisis, interestingly, you see this kind of divergence in views between the oil companies themselves. So some companies are saying, yes, demand has peaked. Others say maybe. Others say, no, we're going to go back to normal. So these are the oil majors by themselves. And then you add other organizations. So there's really disagreement in terms of when we're going to hit that peak and decline. Bear in mind that the OECD oil demand has actually peaked several years ago and has been declining in that respect. And if we look at where the demand will be heading in the future, we should be looking at Asia, because this is where the growth, it is the growth center for oil demand in the future. But I mentioned earlier that when you have a peak oil demand, you're talking about a shrinking market, and that will have not only economic implications, but also political implications. Because in a shrinking market, you will find competition intensifying between producers, and typically you have the high-cost producer being squeezed out first, and the low-cost producer is going to be the last to leave the market. So in principle, producers within OPEC, particularly here in the Middle East, are supposed to be the last to leave the market. So actually, we're going to see our reliance on the Middle East increasing, not decreasing. But I wish it was that simple, because here you have the social cost, the economic cost of poor diversification also add to the cost of oil that is required, or the price of oil that's required to balance the budget. So it's not that easy, and we may well see better or closer collaboration between governments to ensure like an equal market share up to a certain point between the key producers. So it's not as simple as just saying that demand is going to reach a peak and starts declining. First of all, we don't know when, but also we have to start really to think about its implications, not just on the consumers, but also on the producers, because it's not as obvious as saying that's it, we're going to have this producer in the market. Actually, it might become more political than what we have today.
Thank you, Carole. I would take advantage of Massimo Nicolazzi being here so that we will close the webinar with sort of advertising for the books of the three of you. But Massimo, I leave the floor to you for a short either question or comment or both to Carole and Mike, and they will answer, and then we'll, I think, say hello to everybody. So Massimo, the floor is yours.
Thank you very much, Carlo. Thank you. Thanks, IBL, for organizing this thing. Some of my myths are coming true. I have obviously been following the whole thing with the small Bible in front of me. And it was a pleasure to listen to my connection with that. Now, well, very few remarks and to end up with very quick questions. David has been very reassuring by telling us that the new normal will be normal, which we all hope will be. It may change a bit, but we cannot predict it, so it would be a moot exercise to discuss it now. The bottom line of a number of messages that Carole gave us is that at the end of the day, the transition from fossils will have to be financed by fossils, which is something that in calculating timings and ways, we have to keep in mind. Two questions. My life has been long enough to go through and bypass the years of the peak and dip down into the age of abundance. Check price crises that have been overproduction crisis most of the time, et cetera, et cetera, et cetera, et cetera. The question is, will the age of abundance last forever? Or, and I come back to something Carole said, or if we have a short-term fall down on investment volumes, may we find ourselves in some temporary difficulties 4 or 5 years down the line? And I'm saying temporary, obviously. I'm just thinking about investment time here. Shale is quick, conventional, much less. Second question, let's admit for a second, I know Michael will be horrified at the use of these words, but let's admit for a second that stranded reserves and stranded assets may become a common belief. You will always deny it's going to be a reality, but I'm saying a common belief. The 1931 paper you have quoted must have been Hotelling for sure. Put yourself, and it is for Carole as well, put yourself into the shoes of a big producer and low-cost producer, Saudi Arabia, just to quote one. If you were to share the belief in stranded assets, and if you had read Hotelling, what would be your production behavior? Last, I'm listening about oil prices and all this, but would you agree that the timing of substitution is going to be dictated essentially by money, technology, and also by population trends? I mean, in a world of 9 billion people in 2050, we might have done very well in terms of energy intensity. We may have invested in a number of photovoltaic fields so that we have no room to live in because it's all taken by them. Do you see these factors in the future as something whereby we should start talking about the energy market and not just oil price? And an environment where technology will dictate very much of the timing. I'm thinking that today, for example, you cannot substitute for oil in mobility. You cannot do power generation with just intermittent sources. It's a long way to Tipperary still. But are technology and population going to be important factors in your projections? Thank you very much. And thank you, Carlo, again.
Thank you, Massimo. So I leave the floor to Mike and Harold Hotelling, and then to Carole. Bye.
Okay. Thank you very much, including for the ad, Massimo. You're obviously the type of student professors hate because you know the subject and ask bad questions. I'll send you a paper I wrote, Eppring published in Washington on resources and neo-Malthusianism. And basically it argues that the resource base is very large. Much of it is uneconomic now, but technology tends to make it economic over time. With stranded assets, we've had stranded assets for a long time. In 1986, I was in Alaska and I said, you know, the natural gas on the North Slope is too expensive. It's still up there. They haven't invited me back, as you can imagine. But you know, the value of that natural gas asset is I think, close to zero. And I actually advised a company to sell it off for any price 20 years ago. They didn't, and they're still sitting on it. So I think that's the case. I think you're right about the energy transition. It's definitely a question of money and technology. But frankly, most people today would not use coal in their houses, no matter how cheap it was. You know, it's dirty, and most of us in the West can afford better fuels. So it is a complex equation. I can imagine 100 years from now, everything will be electricity, and it will all be non-emitting sources of power generation. But that's a long way off. And I think 100 years ago, nobody thought we'd be here where we are today, that most of the technology we have would surprise people.
Thank you, Mike. Carole?
Yeah, I will comment briefly on the three important aspects that Massimo referred to. But in terms of difficulties for investment, of course, we're going to see investment struggling and suffering in some countries. But these are typically places where investment was already shaky, perhaps before the crisis, and the crisis amplified that. And here I can think of countries such as Nigeria, for instance, or elsewhere in Latin America. So these places we might see, unless governments introduce some pro-investment policies, investment-friendly policy, we're going to see their investment to suffer even more. And that will, of course, affect supplies in the future, but then we have to look at the global balance and not just of supplies coming from one area. And actually, speaking of that, one province I really admire, and I started my career working on it, that is the North Sea, because the North Sea peaked, I mean, many years ago, and still investment has been ongoing because of investment friendly policies. That's something to bear in mind. It's not just, you know, as you said, it's not just about prices, but there are certain areas, high cost areas such as the Arctic. Arctic was a very hot discussion topic in the early decade of the century, and then after the financial crisis of 2008, it kind of evaporated from discussion, partly because of the high cost, but also because of, you know, environmental issues. In terms of stranded assets and the behavior of producers, I think, you see, if you are the low-cost producer, you should behave as a low-cost producer, which means you should maximize your production, that prices collapse because you're going to be the one left in the market, but because you have other economic and social obligations, such as, for example, if you think of Saudi Arabia or Iraq, about the oil price to balance their budgets, they are much higher than what they actually produce. So this is where there's a political economy dimension that comes into the picture in terms of determining of how you should behave as a producer. And then finally, in terms of technology, of course, technology is very important because it partly improves the efficiencies of applications that we are aware of. I mentioned earlier the renewable energy, solar and wind, and also, but also it can also improve the cost of exploration and production with the conventional fuels, such as with oil and gas. So people were talking only about efficiency improvements in solar and wind, but they were much more impressive, perhaps, efficiency improvements in the oil and gas sector. And technology also, what history tells us, is that it can close one door for a sector, but then opens another door for the same sector. And that's what we saw with the development of the internal combustion engine in the late 1800s. So that gave oil a lifeline after electricity was developed. And then with technology, one thing that comes to my mind, however, now we're focusing a lot on oil markets, but there is another dimension that we have to think about when we transition to a greener future, is that I feel that the discussion we're having today, we're going to shift it to talking about the mining sector. Because investment in renewable energy and the push for the energy transition is going to increase the demand for certain metals and minerals, and that's going to open an entire new chapter with all its complications and problems. Some of them we are discussing today, but some they will be were overlooked in our discussion. So yes, we're really focusing about the energy transition for a cleaner future, but there is also a dirty side to that discussion, which is the mining aspect.
Okay. Thank you. Thank you very much, Carole. Thank you, Mike. Let me end with just a little bit of advertising because we have mentioned several books, and I think all of them deserve to be read. First of all, Out of the Energy Labyrinth, that was written by Carole together with Lord David Howell in 2007, and I think this is the kind of book which is very interesting to read in retrospect, and as I said, you got a lot of things right. So compliments for your foresight, but it's still a recommended reading. Then we get to The Peak Oil Scare and the Coming Oil Flood by Lynch. This is a more recent book. It was published in 2016. In 2016, I think oil prices were still relatively high, but I mean, never a title was so fit for a time like this one. I think.
Thank you.
And finally, Massimo Nicolazzi, who is a very good friend of IBL, he wrote last year L'Elogio del Petrolio. It's an Italian book. In English, it would be In Praise of Oil. We hope to see an English edition of the book as well. So thank you very much for joining us. Thank you, Carole. Thank you, Mike. Thank you, Massimo. And of course, thank you to all of the attendees who stayed connected since the beginning of the seminar. I leave it the last word to Enzo, who is going to advertise next IBL's webinar, which will be, I think, no, it will be another webinar aimed at Italian as well as foreign attendees. So we hope that some of you will get connected again in a few days from now. Enzo, the floor is yours.
Thank you, Carlo. All the attendees can join us on the 4th of June at 5 o'clock. We will speak about the Swedish response to the coronavirus crisis, another seminar in English language, and they can listen to the words of Nils Carlons, the CEO of the Ratio Institute, and a philosopher. Riccardo Manzotti is a professor in the University in Milan. And the chairman will be our director, Alberto Mingardi. If I can switch to Italian, so sorry.
Yes, please.
Yeah. Chiunque volesse appunto può trovare tutte le informazioni per connettersi questo giovedì alle 5, sempre via Zoom e Facebook, sul sito dell'Istituto Bruno Leoni, brunoleoni.it, c'è la scheda dell'evento e tutte le informazioni per questo webinar sul cosiddetto modello svedese. Buona serata a tutti.
Grazie a tutti. Thank you everybody and see you next time.
Grazie.
Bye.
Bye.